Today we are going to go over a property that was brought to our attention earlier this week or late last week. I forget.
Late last week.
Is this, are they looking for additional help or are they just looking for investors or what is this one?
So it was sent to me by another friend, who's his friend is wanting to be an LP in the deal, and he sent it to me because I can do things like look up what the actual rent is on a website and compare look at the comparables and their rent and square foot, and I can look up reviews and all those kinds of things. And then since I have a pretty extensive network, I can see if anybody else knows anything about the deal, and that's why it was sent to me. And actually, it was the numbers that made me the most, um, I guess, turned me away from the deal the most, even though I don't really look at numbers.
Well, I looked at a few of the numbers and some of them were pretty surprising. I'll pull it up. If you're catching the recording, you've probably edited quite a bit of this just so you can see, because I think usually there's confidentiality agreements need to be signed with this. So we'll just clean it up so that we don't encroach on any of those confidentiality things. So this is a property in West Texas. Um, it's like 13,224 units, 5-year hold time, and 7.2 equity raise. So to me, this is looking like it's 13 million and we're raising more than 50% of the value. So I'm already raising an eyebrow. What's going on? Um, Not necessarily a bad thing, but at least I'm on the lookout for things that will cause this. So 7% cash on cash return, 20% averaged annual return, 16.3 IRR, 2.0 equity multiple. Bonus depreciation year one, 33 to 37%. Then the 70-30 equity split. One thing I noticed is they have these little asterisks, um, but they don't have what the key is for the double asterisk. So I'm wondering what that is for. I see it for this one.
That's one more detail that was not addressed. That I found that throughout the deck,
That they
which was
would
another red flag to me.
they would highlight something but then never answer what it is. So it might as well just leave that double asterisk off.
But I'll tell you what it's why it is there. Because in later slides, they explain that once this hurdle is reached, it's no longer 70-30, it becomes another one. And then once this hurdle is reached, at the end, it goes to a 50-50 split. And there's an intermediary in there also, like a 60-40 maybe.
Yeah.
But they didn't
Um,
say that there.
so they're saying 7% cash on cash return, but that doesn't look like they have a preferred return, but they're just estimating 7%. So I know people who, if they don't give a pref, they do a 80-20 split. But I don't know. Everybody can do their own deals however you want. This is what I look for if I'm going to invest in it. Um, Already some red flags are being thrown.
If it's 70% or if it's 7% cash on cash, but a 70-30 split, that means that without a pref, everybody's getting the 7% cash on cash, even GPs.
It means everybody's getting the 70-30 split from the beginning.
Okay.
So with a preferred return, the LPs take all the cash flow until that preferred return is met, and then you go through the split with the GP. So right off the bat, the GP is making money off the cash flow as well. Um, so 506B minimum investment 50K. Funds are due by April 23rd. So that was already
Mhm.
2 weeks ago, a week ago, a little over a week ago. Distribution schedule starts after the second quarter. So what this is, it's worded kind of funny, and we do it too, is they're saying it's not going to start at the second quarter. It might not even start at the third quarter. It's just you're not for sure going to get anything during the first 2 quarters. It might be quarter 18 or whatever when you start getting it, because 18 is still after the second. So they word it like that to protect themselves. Um, but yeah, you try to predict when you're going to start doing distributions, but it's hard to do from the beginning. So I don't hold this against them. I'm just letting you know, as an LP, if you're watching this, that's what this means. So we have properties ourselves that we're withholding distributions on, and it sucks, but we're doing everything we can to get distributions out. So capital contributions 6.5 million. Purchaser credit for repairs 600K. Tenant and common member 720. So this is probably 1031 funds if I had to guess.
But I was guessing too.
And then so the loan amount is 9.4 million. So the total sources is 17.3. Purchase price is 13. Legal organization expenses 30K. That seems a little high to me, especially with closing costs as 162. So that's 192,000 in closing costs. Um, manager management fee. So let's see what the closing cost percent is. So 192,000 divided by 13. So 1.5% closing costs. I don't know. Maybe. Wonder what
Not insane.
the required escrows is.
You can't highlight on it very easily.
No. The manager organizational and due diligence fee. This is your acquisition fee. So let's see what that is. 524000.
Oh, it's 4%. It's later on.
I know. I'm just letting people know that they can
Oh, okay.
calculate it from this. So you do 524,000 divided by, let me share my calculator.
You just divide it by the 13.1.
Yeah, calculator. 524,000 divided by 13.1. Yeah, 4%. That is, I'd rather high for acquisition fee. Um, that's a big red flag right there. Probably wouldn't even go any further into it if I saw that the team is making 500,000 on a $13 million property. Um, let's see. So year one, 6,800. Year two, 6,500. Year three, 7,000, 75, 74. So that averages to your 7%, maybe a little bit more. Let's see. They don't ever say what the going in cap rate is, do they? We have to calculate it.
I think it's actually further down. But if you'll scroll back up real quick, this is another issue I saw. Um, down one on the units. So if you'll notice, everything is one bathroom, but when you actually go further, all the 2 and 3 bedrooms have 2 bathrooms. But on that particular, it was just another lack of attention to detail that I caught, was that they didn't get that table correct. And later on, it's listed when they're looking at it per unit. In the next
Yeah.
table or tables down, it talks about it like you see that there's different bathrooms and not every unit type has only one bathroom. It was just an attention to detail thing that was missed, and that was a red flag to me.
Well, you can see here, this one has 2 bathrooms. All the 2 bedrooms have two
All the twos and
baths,
threes too.
and all the threes have 2 baths. That is
Mhm.
interesting.
Yeah, it was just it was a attention to detail thing that was missed. And in my mind, if the team has a deck that misses those attentions to detail, what does that say about team operations later on?
Yeah. They're saying they're going to do an exit cap at 6%. I'm wondering what the going in cap is. Um,
And I think that's on one of the later tables, but
yeah, I'll look for it, but we need to keep
I'm
that
not
in mind.
100% sure.
6%. To me, that seems low. For West Texas, I could be wrong, but let's see what the going in cap rate is at first, and then we can see if it's a good number or not. Um, so property overview, 21 buildings, 224 units, 10 acres. Wonder what how old the roof is. They don't say how old the roof is. They probably don't know. And with it being in West Texas, they may be having to repair some in the next 5 years.
I think when you look at Cap X, it addresses it.
Okay. What the property looks like. Again, we'll blur out the names
Where-
just for confidentiality. Units look like fireplaces. I don't know. I'm kind of worrisome about fireplaces in apartments just because of that one apartment we
Yeah,
put a offer on that had a burn building because the fireplace got out of hand. So business plan overview.
I think on the
1.6 million
exterior,
for
it talks about it.
1.6 million for exterior. That's complete replacement of roofs. Okay. Mail center updates, update exterior lighting at a dog park, car washing, clean exteriors, add more grill areas. Interior. So this is what 224 units. So that's 672,000. Okay. 672,123 divided by 4. They're putting about 3,000 into each unit, so they're not really doing any heavy lifting.
Well, not all of them need new LVP. A lot of them had LVP from what I could tell. There are some with carpet, but I'm not sure those aren't second story where they put the carpet in for the hopes that it dampens some of the sound.
Yeah. So new two-tone, yeah. Yeah, if they're doing this in every unit, you'd be spending a lot more than 3,000. Vinyl flooring alone on these is going to be probably about 35 to 4,500 alone. So created dog park, additional covered parking, washer dryer lease. Let's see financial summary. So this
So
is
this is another spot where I was like, wait a second, because I was looking at the upgrade rent increases, and they seem really big to me. So are they cumulative over the 5 years, or is that what they're hoping to add each year?
I'm looking at what year one NOI is 5.5%. And they're thinking to sell at 6, but I'm wondering what they're buying it at. All right,
I really thought it
upgrade.
was here, but I guess it's not.
So which one were you looking at?
So I was just looking at like the upgraded rent increase. And is that, I mean, even cumulative, it's a lot. And just knowing what I've seen from friends and everything else about just things over Texas, um, it just seems like really big rent growth. And I talked to another friend that has a multifamily property in Lubbock, and they've seen an increase in vacancy by 1% across the board. So it used to be like 8%, now it's at 9%.
408,771 divided by 235,020. So they're increasing it by 2.5% per year. So I mean that's not super outrageous. That's just gross potential rent, not the updated gross potential rent. So let's see what two,
So
four,
then it can't be cumulative. That's how much they
seven,
expect to get year over, like
nine,
individually each year. That's
yeah,
insane.
2, 3, 5. They are going 5% from the gross potential rent to updated gross potential rent year two. Um, with the as minimal of upgrades as they're doing, I don't know if they're even changing like like the renovation of it versus just keeping up with what's already there. So I don't know if that justifies updated or increased rent versus maintaining it and just following your normal rent schedule. Does that make sense?
Mhm.
If they were putting in like 5,000, 7,500, or 10,000 per unit, then I can see justification of increasing the rents. But 3,000 for what they want to do, um, that is a red flag to me.
When I'm looking at the exterior stuff, none of those things do anything for, none of those add anything to the
So,
NOI.
so the replacement roofs does not increase, has no ROI. Parking lot asphalt has no ROI. Mail centers has no ROI. Landscaping has no ROI. Concrete repairs, no ROI. More covered parking
Maybe.
does have potential for ROI. Update exterior lighting, no. Dog park, you might get another person who has a dog versus not a dog. So that's just what dog rent every pet rent every month. So very minimal ROI. Cleaning the buildings, no ROI. Pool furniture, no ROI. Pergola, no, no. So yeah,
There's no
bare
direct ROI except for potentially
of
covered parking.
exactly. And then with the minimal upgrades in the interior, $3,000, you're not you're not changing the state of that unit. You're not going from like a C to a B or a B to an A. You're maintaining a B is what you're doing with this. Because you're replacing carpet as it's wearing out, or you're replacing floors as it's wearing out.
Yeah.
You're replacing appliances as they're wearing out. So I mean, there's nothing really here to justify that huge increase in the rents. So that's another red flag for me.
Yeah. Well, and I also I looked at the comps and looked at their rents and they're not that far off. I mean, some of them were kind of far off, but even the ones that were a lot more, they had less vacancy than this one does. And after seeing where it was on the map and seeing another one super close to that on the map that had more similar pricing, I'm wondering if it's location and again, just unit mix. But
Yeah. One thing to also know is this is a price per square foot. Are you comparing it to other properties that have bills paid or some bills paid or what? And so you have to compare apples to apples. You can't say, all right, well, we're at 99 cents per square foot, so we can increase it up to 100 or $1.22, even though the enclave, maybe they are doing water and sewage included or gas included, and you just pay for your electric or something. Or maybe it's all bills paid. So things you have to keep in mind. Um,
well, and like I looked at Enclave and Woodcrest and they're only a mile and a half apart and they've got similar occupancies, whereas the other ones are in better locations in my mind, because from when we lived in Lubbock and they have higher occupancies.
yeah. Um, so this, I think the cash flow projections looks pretty aggressive.
Yeah.
Gross scheduled rent. What happened? 100%. Okay. Rental income 1.7. Utility reimbursement. So I was running some numbers here. So their numbers, they're starting out at 111,059 divided by 241,461. Oh, yeah, so 45% um for utility reimbursement for year one. I took this number, utility reimbursement, divided by the utility bill. So now let's see if I can copy and paste it. Divided by utility I hate this calculator. Why do I have an RP? So what was it again? It was 233.
By 266, 528.
Here, there. 233. 623.
625. Oh,
233.
625.
623.
Oh,
Divided by.
oh, sorry, I misread that. 266, 528.
So it goes from 45% to 88% for their rubs for
Well, and
utility reimbursement.
my other thing was that they were increasing rent and adding rubs.
Yeah. I don't know if there's existing rubs or not, but they are increasing rubs and increasing rent during this whole business plan.
And when I looked at the website, I couldn't tell if they were currently doing it or not.
Um, Assumable loan. Okay, so this loan to value, they're getting a really good loan to value for an assumable loan. 4.3%, 4.29%. That's decent. Term remaining 25 months. So they have to do a refi or something before this is over. Fixed mortgage amortized over 30 years. So maturity date May of 26. So it's actually 24 months now. I would have said term remaining and go after closing, not after the day that they were doing this webinar. That's kind of weird. Waterfall structure. This one is weird. On the sale of the property, the waterfall is up to 20% ARR, which is the annualized
Average.
rate of return. The split is 70-30 for GP back end sale plus 20% of the GP on cash flow. I don't even know what that means. Once 20% ARR is achieved, GP catches up from 20 to 30% cash flow. Over 20 to 23, it splits from 60 to 40. Over 25, it splits from to 50-50. So what happens between 23 and 25? They don't say.
Mm-mm. And at first I thought it was one of those attention to detail misses. That they didn't go up to 20, like 24 or up to 25. I don't know.
And then once all capital is returned to investor, the split adjusts 50-50. So
The fees
this
underneath
is
are a red flag too.
this is a red flag here. If they refi, say they refi and give their investors money, but they're not doing any distributions up until they refi, and say they get some miraculous refinance where they get all of their initial capital back, they can pay back all of the capital the investors put in. Then from this bottom line, they're splitting everything 50-50 with the investors. Now, granted, the investors have their initial capital back, but they're not getting anywhere near the returns that they're going to get for the 70-30 or anything like that. Managers shall receive the following fees: one-time acquisition fee of 4%. We already established that. A yearly asset management fee of 2% of the property's total income. That's pretty standard. A transactional fee in the amount of 1% of the loan amount. What does this mean? Does this mean they're taking 1% at refi?
I thought it I thought it would have been at the assumption and at the refi.
Yeah, it might be also whenever they acquire it and they do it at a refi. So that
But
one
either way, that's not one that you see very often. Or it's
I've
not one I
never
see very often.
I've never seen it. Sometimes I see like a disposition fee, but that only happens on the sale. not a
Mhm.
transaction fee. And they might be doing it on the sale also.
Yeah, because it's just transactional.
Yeah.
So who knows?
Anytime there's a transaction, they're taking a 1% fee.
Just heavy
Um,
fees.
yeah, fee, very fee heavy. Acquisition fee. Typically you want to see about a 2%, maybe 3, depending on the performance of the group. But coming out, I don't know anything about these people. 4% right off the top. That's a huge red flag to me. This is speaking from one, we've done LPs. We've never LP'd into anything that had anything over 2% acquisition fee. And two, coming from the GP side, we charge a 2% fee, and we don't even take the acquisition fee until we raise all the capital that we're gonna to raise. So things to look out for if you're watching this. Market comps, we sort of went over these already.
Yeah, and for people that don't underwrite, one of the things you can do is go to the websites of each one of these. One of the things I discovered was that two of these are managed by the same company. And so they were pretty similar in vintage and rent. Um, for me, it was really just going through and checking numbers, um, because I found discrepancies between the websites of the actual properties and what was being reported in this particular deck. And again, to me, that's just failure, to pay attention to details.
Yeah, and looking at these properties, this one is 10 blocks away roughly from this one. It's about 5 blocks away from this one. It's up 5 over 8 blocks away from this one. So not too terribly far. So I guess I don't know.
Well, but
I
when you
don't.
look on them, like, so you remember where Science Spectrum is?
Yeah.
So Enclave and Woodcrest are on the same side of the loop, a little bit further up.
Right. Yeah. So Enclave is outside. Um, Fountains is outside.
But I think Fountains is closer to Texas Tech.
No.
Oh, is it not? One of them is
No.
closer to Texas Tech and is at the
Chicago,
higher end.
Chicago is over there where our house used to be.
Okay.
Past Slide, between
Okay.
Slide and Frankfurt.
Okay.
Um,
Oh, and just so y'all know, like between inside and outside the loop, when we lived in Lubbock, the most desirable places were inside the loop and lesser valued properties were outside the loop. So I don't know how much that holds now, but that's the way it was then.
so,
I don't know where that estimate came from. And I had a big problem with that.
so they're saying they should sell this at 77,000 per door,
But they
which
also say the
is
average age is 1969. And if you look on the comps, the average age is probably more like 1980, 1981. So I don't know where 1969 comes from or what they're using as, but
they're
that's what I'm saying.
use they're using, I think, all of the apartment sales in Lubbock
Okay.
for 77K per door.
But that's
Um,
not apples to apples.
no, but so that's where the 77 times 224 is 17 million. And so 17 million minus 13.1, which they're getting it for, is 4.14 of already they have equity. But what's their raise is what is the raise? 17 point
7.2, I thought.
17.3. So they're actually putting more money into this than what the thing is worth if you go by those numbers. So don't go into this thinking, oh, we're already gonna have equity in this deal. It's like, no, not really. So um this town has grown a lot since I lived there. Market rent, medium unemployment, median age. Okay. This is just stuff about the city. You're always going to have nice, pretty pictures and try to tell you everything good about it. So,
Yeah, I don't think there's really much more data. Oh, one more thing though, I did notice. If you look at 33 and 34, XFAB and Taylor are reversed. It's just another detail thing that was just completely overlooked. So they have the wrong logos with the little blurb about them. And I know it seems kind of goofy, but again, it's the lack of attention to detail in the deck that just
yeah.
concerns me.
So here's the team. I've never heard of any of these people. Doesn't mean they're good or bad people. Just um yeah. So that's how we analyze a deal. Just from a pitch deck point of view. We um ideally you'd want the underwriting to see how they predict all their numbers, but there's a lot you can decipher from the pitch decks if you don't get their underwriting. If everything starts to look good and you're actually thinking of investing in this, that's when you want to go and get the underwriting and double check and make sure that they're doing things the way that you would want them to do. Um, Now there are some deals where the numbers look good, everything looked reasonable, but the team just didn't carry the business
Yeah.
plan the way they said they would. And so that's when you have to know the team as well as the numbers whenever you are looking into a deal like this. So, is there anything else?
No,
Okay.
I was just proud that I was able to do something with it without having to really look at underwriting and stuff.
Yeah, there's a lot everyone can do without having to like deep dive into the numbers. So yeah. All right. So this was office hours for today is May 2nd. So we'll get this edited and put up there and we'll talk to y'all later.